Thank you for joining us for today's edition of MarketPulse presented by LodeStar Advisory Group. My name is George Corrali and I'm the Managing Director here at LodeStar. We are a fee-only, registered investment advisor specializing in actively managed ETF, mutual fund, and closed-end fund portfolios. I'm a certified financial planner and member of the National Association of Personal Financial Advisors, otherwise known as NAPFA. NAPFA is the premier financial planning organization in the nation, and its membership standards are the highest in the industry. We recorded this presentation after the close of the market on Friday, August 8th, 2014. So what we're going to do here today is walk you through a few charts, but first I want to talk to you about some obligatory disclosure information. You should not construe anything we talk about here as a recommendation to buy, sell, or hold any security. You should always do your own research to determine whether the securities we talk about are appropriate for your portfolio. As you know, investing involves the risk of loss, and investment should always be made based on your specific needs and objectives, goals, time horizon, and risk tolerance. LodeStar's clients may own securities mentioned in this presentation. All charts and other statistical data were obtained from sources which we believe to be reliable, but we do not represent that they are accurate or complete. And finally, all opinions expressed and data provided are subject to change without notice. So let's jump right in. I'm going to reference moving averages in this presentation, specifically the 50-day and 200-day moving averages. Moving averages smooth price data to create a powerful measure of trend direction and are a very simple tool for finding support and resistance levels. The 50-day moving average is the average price of a security over the last 50 days, which often acts as a support or resistance level. The 200-day moving average is a long-term moving average that helps determine the overall health of a security. A security that is trading above its 200-day moving average is considered to be in a long-term uptrend. A break below the 200-day moving average is often viewed as a warning signal of potential underperformance. So let's take a look at a few charts. Here is a chart of the S&P 500 SPDR ETF, symbol SPY. This chart goes back about 12 months to September of last year. The 50-day moving average is here represented by the blue line. The red line represents the 200-day moving average. We drew this black line in, which represents support going back 12 months or so. And you can see over the last 12 months we broke this support line or trend line a couple of times, only to rally above it and keep the trend moving higher. Here we are in the right-hand part of the screen where we broke the trend line, broke the 50-day. We sit almost halfway between the 50-day and 200-day moving averages. So it remains to be seen whether we can rally up through this area once again, or whether we may break down to the 200-day moving average, which sits about 100 S&P points lower from where we closed. Here is the Russell 2000 iShares small cap ETF, symbol IWM. And here again, the 50-day is the blue line. The 200-day moving average is the red line. We drew the black line in. So look, for most of the year, we've had an above-trend performance until April of this year, where the small caps broke through their 50-day and major trend line, and even the 200-day after a rally, and then here we sit below the 200-day moving average once again. So a completely different picture than the large caps. In fact, the small caps are underperforming the large cap sector by about 8% this year. We reduced our exposure to small caps several months ago, and we hold a very small percentage of this particular sector in client portfolios. The Vanguard Europe Pacific ETF, symbol VEA, is a foreign large blend ETF with a current dividend yield of 3.18%. You know, since late last year, we've seen periods of strong outperformance by assets from the most impacted parts of Europe, leaving many of us wondering if Europe is turning a corner. We have had intervention by the ECB, and the ability of those liquidity injections to stop the bleeding in the economy has certainly helped. So here we go back to September. We have been above and below the 50-day. We touched the 200-day moving average here in February. We are now at the 200-day or just below it. So the one thing I wanted to point out on this chart is up above here we see what's called the Relative Strength Index, this channel here. And if you look here at the right-hand part of the screen, you see this green circle. It's just about at the bottom of this channel or slightly above it right now. And every time it's touched the bottom of the channel, it has we've gotten a rally. So here back in February, the same thing happened, and we almost touched it back here in December and got a rally. So we are fairly constructive on this particular ETF. This next chart is a chart of the iShares High Yield Corporate Bond Fund ETF, symbol HYG. Again, 12 months back to September of 2013, pretty much above the 50-day moving average all year. And then we broke through the 50-day and the major trend line. Actually even broke through the 200-day briefly before rallying above it. And look, a lot of air has been coming out of the high yield space over the last couple of weeks. There's actually been a stampede into high yield bonds over the last several years. Investors have been really hungry for returns after several years of interest rates near 0%. High yield debt issues, also known as junk bonds, are fixed income instruments with a rating of BB or lower by Standard & Poor's or BA or below by Moody's. And they have a greater risk of default compared to safer investment grade bonds. This pullback here that you see on the upper right hand part of the screen in junk bond prices could signal that market participants are rethinking their willingness to take risk, foreshadowing further declines in stocks and other risky assets. The flight from high yield could also be a result of market fears that all risk asset valuations will be weaker when quantitative easing ends in a couple of months. Here is a chart of the iShares Aggregate Bond Fund ETF, symbol AGG. And here you can see that this particular ETF has performed quite well this year. Here's the beginning of the year. And you can see that it's remained above its 50-day moving average for the entire year, basically. So really outstanding performance from this ETF. And bonds as a whole have actually performed quite well this year as well. This particular ETF is composed of the total U.S. investment grade bond market. Like I said, it's performed well this year as a 10-year Treasury yield unexpectedly declined from 3% at the beginning of the year to an intraday low of 2.35% this morning. And I know that surprised many investors and pundits as well. If you recall, the 10-year bottomed at approximately 1.36% in early to mid-2012. So despite this relative outperformance here, the long-term trend is still higher for yields. And we would not be a big buyer of intermediate term and long-term bond funds at this juncture. This last chart is the Spider Gold Trust ETF, symbol GLD, and kind of a mixed bag here. We had a big decline at the end of 2013, and to start off the year we had a big rally. We had some sideways market action, and here we sit above the 50-day and 200-day moving average. We're not particularly fond of this ETF at this point in time. We do think it can trade higher, perhaps to the $1,400 an ounce level based on the state of the world and current geopolitical risks, and the fact that we're coming into historically a couple of weak months for the stock market. But we wouldn't be an aggressive buyer of this ETF until it trades down to our long-term price target of approximately $1,000 per ounce. So that concludes our presentation for today. Lastly, I just want to mention that we provide MarketPulse presentations on a periodic basis, but we are speaking with clients and prospective clients here in our office in Short Hills, New Jersey, all the time. We offer a free portfolio review. We'll go over your goals and objectives, provide a professional second opinion with respect to every position in your portfolio, and discuss some different strategies that you may be able to implement to achieve your goals. You can call us at 973-218-2440 to schedule that. You can also send us an email. The general email for the company is info@ldstar.com. My personal email is gcorrali@ldstar.com, so you can email me directly if you'd like, and I'll be more than happy to answer any questions you may have. Our website address is www.ldstar.com, and I'm also active on Twitter for those of you who may be more social media savvy. My Twitter handle is @GeorgeCorrali. Thanks so much for listening to today's edition of Market Pulse. We'll see you back here soon.